Well, greetings and salutations, test takers. This is the Series 7 guru. I'm coming to you from my studio here in fabulous Las Vegas with a question and explication request. The best free supplement to your paid study materials is my YouTube channel. But if you don't have a Kaplan Q Bank, I highly recommend it as a paid supplement. With my Guru 10 discount code, if you're a Series 7 person, I'm going to put this in the 7 playlist, but I'm also going to put it in the 65, 66 playlist. And I'm going to put in the SIE playlist because you should be able to do this on all those exams. If you don't have that, I recommend it. If it's a Kaplan Series 7 Q Bank, it's about $50 with that discount. For that commercial, Kaplan allows me to give you a free look at Kaplan questions. This is Kaplan QID 1264384. A client is trying to decide between a corporate bond carrying a coupon of 6.25 and a par value municipal bond having a coupon of 4.75. Assuming all other factors are equal and your client's in a 28% marginal tax bracket, what bond should you tell the client to purchase and why? Okay, well, this is very testable. This is called tax-free and taxable equivalent yield. This is about how to make a recommendation. I think some of the hardest questions you encounter on Series 7 are what are called judgment questions. And most suitability questions are judgment questions. This is not. Anytime we can turn a suitability question into a math question, we're big fans of that because there's no interpretation of math. Now, the other thing about math, there's a lot of ways to go. You know, I had a student, he said, Dean, I'm a math person. I don't need to memorize formulas. Give me any two numbers I can solve for the third. So at the end of the day, as long as you come with the right answer, good for you. You know, I'm going to show you how I would have gone about doing this. It's a buffet. Take what you like, leave what you don't. All right, so we're comparing a 6.25 taxable yield, and we're comparing a 4.75 tax-free yield, and we're trying to decide what would be best for this customer. Now, no matter which way we're going to go, you're always going to need, or should be a pivot for you or a hint when you see that this person's in a 28% tax bracket. The minute you see that in a question, you kind of know what's coming next. It's either the tax-free or taxable equivalent yield. I'm going to show you both. You don't have to do both. Either way would answer the question. But if he's in a 28% tax bracket, regardless of which direction we're going, we're going to need to know 100% or 1. You know, what I think of that as how much is the U.S. government confiscating from him or her? You know, taxes are the government's ability to confiscate. I'm joking, right? Taxes are the price you pay for civilization, you know, and the more money you make, the more you should be interested in paying for it. I'm joking again. But anyways, you're going to need in either version, either one, for every dollar, the government's taking 28 cents of every dollar, or of every 100 cents. That's kind of the way I think of it. So what you're left with after paying your taxes is 72 cents or 72% of each of those dollars. Now, the formula for doing this is we're either going to multiply or divide. I will link, I have a separate little carve out 15-minute lecture on this, and I'll link it in the video description and a pinned comment. So this is 6.25, and what we're going to do here is we're going to multiply. So we're going to take 6.25 times 0.72. Where did I get the 0.72? That was from taking 100% minus the tax bracket. And I say, well, listen, after you pay your taxes, you're only left with a 4.5% yield after tax. That is the tax-free equivalent. And your bracket getting 6.25 is the equivalent of getting 4.5 tax-free. And here the muni is the clear winner, right? Because 4.75, you're not paying any taxes. So we are now done with this question. The answer is the question is the customer should buy the muni because it leaves him with more money. Because after he pays taxes on the corporate bond, he ends up with less money than the yield on the tax-free. Now, just because we want to practice, drill, and rehearse, I'm going to show you the other way I could have gone about this. I could have said, okay, well, what is 4.75 worth? You know, considering you're not paying taxes, right? The whole point here, by the way, is we can't compare an apple to an orange. We got to make both these things either oranges or apples to make a fair comparison. That alone is a test question. We're always supposed to make fair comparisons. All right, so I say in your bracket, getting 4.75 and not paying taxes, right? Now I'm going to divide. And again, I'm dividing. I multiply to go to the tax-free equivalent. I divide to go to the taxable equivalent. And I say, taking into account that you're not going to pay taxes, again, 0.72 is that 100% minus the tax bracket. In your bracket, that's the equivalent of getting 6.6 in a taxable yield. And again, I could say, well, 6.6 is once again better than 6.25. Right? So I'm again saying what will leave you with the most money, right? And so even though at first glance, 4.75 looks like, well, that's less, but yeah, you're not paying taxes. So when we factor that in your bracket, getting 4.75 tax-free is the equivalent of getting 6.6 taxable. The taxable bond only pays 6.25. Again, the muni is the clear winner. Now, again, I said there's a lot of ways to go. Another way we could go about this is saying, okay, well, if I'm receiving $62.50 in annual interest, that's par times the coupon or nominal yield or fixed or stated rate of return, and then I have to pay taxes on that. 28% of that is $17.50. So after paying my taxes, I am left with $45. When I buy the muni, remember, I got no tax. Again, the muni is the winner, right? I end up with $47.50 versus the $45 I would get after paying taxes on the 6.25 bond. So again, a couple ways to answer these types of questions. This is very testable. I can't imagine a draw on Series 7 in which you're not going to receive this. Lower probability on the SIE, but it's there. Lower probability on 65, 66, but it's there. And again, I'll link to a little lecture that goes into a little more depth. Remember, inch by inch, your Series 7 is a cinch. Yard by yard, your Series 7 is hard, and I'll see you for the next explication request.